In the latest edition of The Real Deal, we look at accusations against the Alexander brothers, rank top developers in New York City and top brokerages in Miami-Dade and San Francisco, plus look at colorful characters like industrialist Jamie Hodari and element agent Maria Mendelsohn, and we investigate what could happen if community and regional banks start to fail. I'll dive into a couple of these stories with their reporters today. So you wrote a really colorful profile for the latest issue about Maria Mendelsohn. Tell me who she is.
So Maria is the top agent in Wellington, which is an equestrian village in Palm Beach County in Florida. She is Element's number 3 agent nationally, and she's got a pretty interesting backstory. She started her career working in distress on Wall Street. She herself is a pretty competitive equestrian, and kind of in the midst of the financial crisis and working on real estate deals on Wall Street, she pivoted to equestrian real estate in Florida and New York.
Wellington itself is a pretty unique market. Tell me a little bit about that.
Wellington is the equestrian capital of the world in the winter months. It's basically the hub for the entire sport from January through April. People come to compete in the Winter Equestrian Festival. So the village itself actually has a pretty short history. The sport and all those events have only been around in the past couple of decades, but it's just really quickly become this hub for the global wealthy in those months. And the real estate is priced fittingly.
Yeah. And tell me a little bit about the perspective that Maria gave you on the Wellington market as a whole.
She has this mixed background of being both an equestrian herself and starting her career on Wall Street. She really credits her success to being able to kind of speak both languages, of the riders, the people who are coming to Wellington with their passion for horses, what they need out of a property. And she's able to speak to the hedge funder fathers, husbands who are really holding the purse strings here and looking at things through a more financial lens. So she's able to really speak to both of those parties. She's also really optimistic about this major development coming to Wellington that's been pretty controversial. It's called the Wellington. It's led by developer Mark Bellissimo. It's about 600 acres in the heart of Wellington and has major visions for restructuring the town, restructuring the equestrian facilities that are available. And the controversy really comes from the project moving land out of the equestrian preserve in Wellington. So the equestrian community pushed back pretty hard against this development, but it was approved a couple months ago. So it's moving forward. And Maria was really optimistic about the impact that it will have on Wellington and the equestrian facilities available to everyone. So she sees it as a positive for people, for horses, and for the real estate market there.
You can read Kate's profile and learn more about Maria Mendelsohn and the Wellington real estate market in our latest issue. So we've been hearing a lot about potential bank failures.
Mm-hmm.
Tell me who's been saying what.
We could start last year, March 2023. Obviously, we had Signature Bank, Silicon Valley Bank, and First Republic all fail. And right after that, there was a lot of chatter about, is this going to keep going? Will there be more contagion? In 2023, there wasn't. And then I guess we could say, I started noticing these echoes in May, where it was Barry Stern, said he was seeing failures coming. He was asked, to be fair. And then at our New York forum, Newmark chair Howard Lubnick said he expected 500 to 1,000. We had other private lenders say the same thing, 2 hours later at our New York forum. PIMCO jumped in. So yeah, it was just a lot of different folks that are high up in the industry sort of saying the same thing.
Yeah. And, as I said, we've been covering the potential that this could happen for over a year now. So why is the drum beating louder now all of a sudden?
Yeah, I think it's sort of maybe twofold. For a while, the industry, and still now, was just fingers crossed that interest rates were going to come down in December, everybody was expecting a rate cut by this summer. Obviously, that hasn't happened yet. So all of these lenders, pushed out the maturity dates for a lot of these loans from 2023 to 2024, hoping that there would be rate cuts and it would sort of ease the refinancing. So that's one thing. And then on the other end, it's, office is the big issue, clearly. We all know that. But it hasn't gotten better for most of these office buildings. So it's like these refinancings are coming up, and it's basically how long can these banks kick the can? And these prognosticators who are saying, failures are coming, are betting not too much longer.
Yeah. If that's true, and the lenders, can't kick the can any further down the road, what starts to happen?
Defaults will happen, theoretically. And if those defaults happen, they're going to show up on earnings. And we could see something that happened with New York Community Bank. They didn't report a lot of defaults. What they did report is an increased provision for credit losses, saying they see defaults coming. When they said that, their stock price, it plummeted. So there was a big sell-off. Investors got freaked out. And if we sort of extend what happened, they got $1 billion sort of like rescue infusion to keep them going. That happened a few months later. But, if there's a big sell-off and depositors get freaked out, maybe because they have uninsured deposits, so more money in the bank than $250,000, which is what the FDIC will cover. They all yank their deposits, you have a run. And I think what's important about what these folks are saying who are saying bank failures, it's regional and community banks. Community banks and regional have a lot of commercial real estate exposure, which we know isn't doing great right now. It's office, but also, valuations are down across the board. So even, for strong asset classes like multifamily, when the defaults happen, the loans will be marked to market, and that shows up on earnings. But if every bank were to mark its loans to market right now, there's like 2,900 that would have excessive commercial real estate exposure, meaning they're at risk.
Yeah.
Community and regional banks, they have a lot of commercial real estate exposure, but regional banks in particular, and I think this is why folks in the industry who are talking about failures keep saying regional, they're more likely to have uninsured deposits. So they're more vulnerable to a run than the community banks, perhaps.
Right. So if we see these runs, these banks start to fail, what happens to them?
Yeah, so they'll either be seized by the FDIC, which is what we saw in March 2023 with that trio I talked about, or they'll be forced to merge. And sometimes, in speaking with economists, what the FDIC will do is say, look, things don't look good for you. You have 90 days to find a merger partner, and it's called a shotgun wedding. And then they have to look for a bigger bank to buy them. And if you're a smaller bank, you have more options. But as you go up the tiers, there are fewer options, and it's possible. So we saw JP Morgan buy a lot of First Republic. But on the flip, we saw New York Community Bank buy Signature Bank's deposits, but did not want its toxic rent stabilized commercial real estate loans. So it's like, it could be tough for some of these smaller banks to find someone who wants to buy the whole kit and caboodle.
Yeah. If we were to have all of this consolidation start to happen, what would that mean for the real estate industry? Because these community and regional banks are pretty important as real estate lenders.
Yeah, they're critical, which is what I sort of knew going into this, but really it cemented it talking to sources for this story. They are huge lenders to the space. And if there's any sort of consolidation, in any market, the product becomes more expensive. So financing could become more expensive. But also, it could be so bad as some of these real estate operators who go to this one bank may not be able to find another bank that will offer them the same product at an affordable rate. And just as an example, so after Signature Bank failed, it was a huge lender to rent stabilized multifamily. A lot of those owners, because of restrictions, are struggling with their assets. Some of them are underwater. So I talked to one borrower who said after Signature failed, she went to JP Morgan and said, will you make me a loan? And JP Morgan said, no way. And after Signature failed, other lenders pulled back in the space too. So there could just be fewer options. And that's tough for commercial real estate as is.
You can read Susie's whole story in the latest magazine. So, Orion, you wrote our top New York City developers ranking for this year. Tell me who came out on top.
The largest, most active developer in New York City this year was Tishman Speyer. It's building JP Morgan's new headquarters in Midtown at 270 Park Avenue. In second place was Two Trees Management, which is building about 2 million square feet of residential on the Williamsburg waterfront. And coming in third was Extel Development. That company is doing a mix of commercial and residential projects.
Yeah. And any big changes to the list, to the market on the whole, in this year's ranking as compared to last year's?
Interestingly, there was much more development this year because of an approaching deadline, which was set for June 2026. Now, that deadline was recently extended until 2031, but developers weren't aware of that, of course. So while there has been some discussion of an inability to build new residential development in the city due to a lapsed tax abatement at the state level, there has been more development, like I said, in order for developers to meet a deadline.
And as you were talking to developers through the ranking, you mentioned the expiring tax abatement and the new one that's come into place. What was their overall perspective on the market right now?
In general, developers would have preferred to simply renew the 421A abatement. What has replaced it, called 485X, developers say the jury is still out on whether projects will pencil out, as they say, which simply means they're unsure of whether they can make a profit given the levels of affordability that the city now requires. Some developers were building affordable apartments with income caps of 130% of New York City's median income. That has since been reduced to 80%. The amount of income the developers can earn on those affordable units has been substantially reduced.
Yeah, so that makes it much harder for things to pencil out, obviously. But some people, it seemed like, are also relieved just to have any new tax break in place. Is that fair to say?
That's fair to say, although developers are still unsure of what kinds of changes they will need to make to projects they have been planning in order for them to be profitable under the new regime. But certainly something is better than nothing, and nothing is what New York City has had in the midst of a housing crisis for the last year.
Yeah. Well, thank you very much. You can read the whole ranking in our latest magazine.